Hello everyone and welcome to another video. I am beating the S&P 500 in 2025 so far. Now, I'll be the first one to admit that that really doesn't mean anything over 1 month. Over short periods of time, like 1 month, literally anything can happen. This was pretty much a 50-50 coin toss to see who would come out on top, me or the market. That being said, it's better to be on top than on the bottom, even though it's been 1 month. This is the first month ever that I'm tracking my personal performance relative to the S&P 500 benchmark and also the MSCI World Index benchmark, and so far it's going pretty well. In January, I pretty much doubled the S&P 500. Do I expect that to continue? No. Am I going to try to make it continue? Absolutely. In this video, I'll be doing a quick overview of my performance over the past month, and I'll be going over my best performers and the laggards in my portfolio. Also in this video, I'll be talking about Deepseek, the new AI model out of China that rattled the markets last week. Now, to be completely honest, there are so many media outlets and news outlets that have covered this story in detail. I'm sure you watching the video have already read countless articles about this in the news. So I won't be diving too much into the detail on this one. However, what I will be covering is something that I think will serve us, both you and me as investors, and that is how this story relates to narrative in the market. And finally, to finish off the video, we've got to talk about Trump and his tariffs. If last week all of the world's attention was on Deepseek, this week all of it is on Trump and his tariffs. This man is just making his presence felt by China, by Mexico, by Canada, and the markets are reacting to that. To be more specific, the markets don't really know how to react to that. We're seeing downswings, we're seeing upswings. It seems that whenever Trump changes his mind, so does the market. So once again, I'll be giving some context around this story, but there are so many news reports that you can read that are in depth covering this. What I'll be focusing on is how best to navigate this tariff Trump market and how best to invest in 2025 and for the next 4 years. Okay, let's dive right into it, starting off with this report that I downloaded straight from Interactive Brokers. And we can see that for January, my portfolio returned 5.82%, which is roughly a double from the S&P 500 that posted a 2.94% over the same period. If we zoom in here, we can see that the top performers in my portfolio were British American Tobacco, Visa, and S&P Global. Now, these two companies, British American Tobacco and Visa, have a special place in my heart, and that is because they are the two biggest positions in my portfolio. Visa is just one of those companies that just does its thing, compounding 10% growth every single year, year after year. This company has been on fire since the middle of last year. The reason why it's one of the biggest positions today in my portfolio is because that level of quality was not reflected in the market until very recently, that is. For the longest time, for the past year, Visa's value rating had been hovering around 82 to 85. Now, keep in mind that anything above 80 on the value rating is an alert for buy. So Visa has been in the buy zone for a very long time, and I had just been accumulating shares because this is a very high quality company. The company recently reported Q1 earnings, and once again, we've got 10% revenue growth. And even better, when we scroll down to the cash flow statement, we can see that the cash from operations did a lot better than 10%. This is one of the highest quality companies in the world, in my opinion. You're never going to get growth levels of 20, 30, 40% in a single year. And that's why sometimes these stocks can be kind of left to the corner by the market. And that's the advantage of being able to pick stocks as an investor rather than buying the entire S&P 500. I also want to have a quick word on British American Tobacco. This company is just extremely cheap. It's still extremely cheap with a free cash flow multiple of 7. As of very recently, that multiple went down as low as 5, which is just incredible for a company of this caliber. When you compare it to peers like Altria has a multiple of 10, Philip Morris has a multiple of 25, and in my opinion, British American Tobacco is not even as risky as some of those peers. If you want more information, the whole analysis is on Rated A. So all I'll say is that this company is still cheap, has a value rating of 91, even after this run-up that the stock has experienced in the past year. If you're interested, I'll probably be doing an in-depth video on British American Tobacco when they release their annual reports in the coming month. So definitely stay tuned for that. All in all, this is the result of buying companies that are of high quality and that are selling for a reasonable price. Eventually, the market recognizes this and re-rates those companies. So we'll see how these perform in February and beyond. If we move on to the bottom performers in my portfolio, we have Broadcom and Microsoft. And I'll be going over that in a second when I talk about the broader market. Now, for the market, it's pretty much the same story, but in reverse. On the left-hand side, we have all of the largest companies in the S&P 500 from the largest market cap to the lowest market cap. If we look at the largest companies in this basket, we can see that all of them had a really bad month. Apple was down 6%, Microsoft was down 2%, NVIDIA was down 16%. So clearly, tech and AI, the themes that did really well in the previous year, were lagging a little bit in January. I like all three companies. I think all of these three companies are very high quality. But another thing that these companies have in common is that their valuations are a little bit stretched. At best, a little bit stretched. For NVIDIA, you could say it's very, very stretched. Clearly, the performance of those three large companies has been limiting the performance of the overall index. We'll see if that continues. Clearly, those three companies were pulling the index upwards in 2024. But if you're familiar with my channel and you watch my videos, you'll know that I'm a more conservative investor. And I wouldn't be surprised if these companies continue to underperform in the coming months. So that's definitely a risk. When you're buying the index, most of your money is going to those three companies, which happen to be some of the most expensive companies in the market. Next, we move on to the story of Deepseek. This is a new model that's coming out of China. It's backed by a Chinese hedge fund. And the performance of the version that was released last week of Deepseek is just as good, if not better, as the models that are currently running the show in the United States. These models include Llama, which is run by Meta, Claude by Anthropic, and ChatGPT, of course, by OpenAI. Now, the bombshell here that's rattling the markets is that executives at Deepseek have come out and said that they've managed to train and develop the new version of the model at a fraction of the cost of what it usually takes to train and develop a high-performing AI model. Some people are right to say to take this information with a grain of salt. The reason they might have a point is that NVIDIA is barred from selling their high-performing chips to China. And so legally, Deepseek cannot even disclose if they even bought some of NVIDIA's high-performing chips. And while I think these accusations have some truth to them, executives at really top AI companies like Sam Altman or Mark Zuckerberg have not come out and denounced Deepseek as a fake information. Sam Altman, who is the CEO of OpenAI, is not coming out and denying the facts. He's coming out and openly acknowledging that OpenAI now has some real competition in Deepseek. He's even reconsidering OpenAI's strategy of keeping their model closed and instead making it open source like Llama or like Deepseek. So the result of all of this last week is that NVIDIA's stock was down nearly 20% in one day. And similarly, Broadcom was down 17% in one day. So why are NVIDIA's and Broadcom stock down so much? Why is the value of these companies down so much just due to one story? When you think about it in business terms, it doesn't really make sense. In reality, you have to consider the narrative that was surrounding these stocks in the first place. Remember that the current narrative in the current market is that NVIDIA and Broadcom are powering the version of the AI universe where building an AI model is super expensive. Right now, any company that is trying to develop their own model has to spend a lot of money paying Broadcom and NVIDIA for their chips in order to build out these data centers and to run the model. The reason NVIDIA stock surged over the last few years is due to the demand for NVIDIA chips on the back of all this AI hype. The same thing can be said for Broadcom. Yes, both companies have seen their earnings grow a lot as companies spend with these companies, but a lot of this stock price is also due to the valuation expanding. And the valuation expands because people expect this demand to keep going in the future. And not just keep going, but accelerate. This is why we're seeing a 47 PE ratio on NVIDIA's earnings that are already sky high and 171 PE ratio on Broadcom. The real reason why Deepseek breaking onto the scene is a notable moment is not because Deepseek's model is extraordinary. No, like I said, all it does is match the performance of OpenAI, Llama, and the other models that are currently on the market. However, it does break the narrative that OpenAI and Anthropic are going to be the leading AI models because they're backed by Microsoft and Amazon, which have all, the monetary power to buy NVIDIA's chips and to build these data centers. And it also breaks the narrative that NVIDIA is selling the shovels in this gold race because allegedly DeepSeek was able to build this model without using NVIDIA's super powerful chips. And that's where I think it's a good idea to take a step back and review some stock investing basics relating to narrative and valuation. You've got two components to a stock's valuation. The first is a stock's earnings. Apologize for my drawing skills, but this is a bar chart of a stock's earnings. This is tangible money that the company is creating that you can value the company on. On the right side, you have a red column, and that represents a company's multiple of the earnings. Together, a company's earnings and the multiple on those earnings equals the company's valuation. So far, so good. The thing is that not both of these charts are created equal. The green bar on the left, which represents earnings, is tangible. This is real money that the company is making. This is gravity that's keeping the stock's valuation in check. In the long run, the market will always price a company based on the green bar. The red bar, on the other hand, the company's multiple, is highly variable. It goes up and down based on market sentiment. When the market is excited, this bar can grow to the ceiling and be super, super tall. When the market is depressed and nobody wants to buy that stock, that bar can go down to the floor. I know I'm keeping things super simple, so if you have some experience investing, please bear with me, but it's always good to review the basics. When you buy a stock and the chart is looking like this, where most of the stock's valuation is coming from the multiple, the narrative, then you only have two options. Either the green bar grows to catch up to the multiple, or the multiple has to come down. When you buy a stock with this setup, then your risk automatically goes up. That's called valuation risk. The good thing about stock investing is that the historical records are available for everyone to see. And let me tell you that history is littered with companies that had this setup and that ended up performing super poorly over the next 10, 15 years. Let's go through some of them. Why don't we? This is Cisco, a company that back in 1999 was supposed to be, the next big thing. Because what Cisco did was that it allowed companies to connect all of their computers together and it basically connected them to the internet. Cisco stock went to the moon, the valuation went crazy, and the stock today is still not at the level that it was 25 years ago. And this is after the company has grown its revenues, has grown its free cash flow for 25 years. Another company is Walmart. Walmart is a great high quality company. The company's still killing it today, the same way it was killing it back then. The problem with this one is that the multiple got ahead of the earnings for a very long time. Even though this is a great company, and even though Walmart was growing revenues and free cash flow for 15 years, the company's stock did nothing. Microsoft is another super famous story like Walmart's. Great company, great product, kept on growing for many, many years. But once again, for 15 years, the company's stock went nowhere because the valuation got ahead of itself. These are all past examples, historical examples, but we can look at some stocks that today appear to have the same setup as in 1999. Oracle is a case in point. This company had a huge spike in 1999, and the company's stock went nowhere for the next 10, 15 years. Today, we can see another huge spike due to the AI hype. Nobody knows where the stock will go for the next 10 years, but this setup is looking a bit dangerous. Personally, I think Oracle is in a better spot than Cisco was in 2000, for example, and that's why it's part of my portfolio. I think this is a high quality company, and I was buying here in the dip in 2022. That being said, I haven't been buying since, and I think it's very overvalued at $168 per share. Okay, but this is the one I wanted to talk about, Palantir. Palantir had another great earnings yesterday. They reported great numbers, huge revenue growth, and huge free cash flow growth. So the green bar side of the equation is looking great for Palantir. The problem is the red bar. It's this valuation. After this recent earnings, Palantir is now in the top 50 largest companies in the world, ahead of companies like Merck, Thermo Fisher, and American Express, almost catching up to IBM. The company brought in $1.1 billion of cash in 2024. That is with 690,000 of stock-based compensation. So more than half of all the cash that they brought in is from selling shares to employees and such and getting cash from that. In other words, diluting the shareholder. If you look at how much cash Palantir actually made from operating its business, it's closer to $500 million. Let's have some fun and compare those numbers to IBM, because IBM is trading for the same market cap as Palantir. If you had $200 billion to your name, you could right now buy out in full either IBM or Palantir. Which one would you buy? In 2023, IBM brought in $14 billion of operating free cash flow. In 2024, it's likely going to be even higher than that. And of course, that includes $1 billion of share-based compensation. So we can say it's closer to $13 or $12 billion. So IBM is bringing in 24 times the amount of cash as Palantir is currently bringing in. So here's the thing. With IBM, you're buying this setup, and with Palantir, you're buying this setup. And it's not for no reason. Palantir's cash flows are small for now, yes, but they're expected to grow at a very fast rate in the next few years. The market can get ahead of itself sometimes, but it's not completely stupid. There is always a reason for the numbers you're seeing in the screen in front of you. That being said, if you're investing in Palantir today, you're like this motorcycle driver. You're driving very, 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 very fast, much faster than IBM. Any little bump on the road can send you flying and breaking your head with a concussion, never to ride a motorcycle again. Any little change in Palantir's story, and this red bar can go down to the same level as the earnings, and you lose 90% of the money you put in this stock. So I'm not trying to take a hit at Palantir investors. I don't want the stock to go down. I'm just saying things as they are. A fact is a fact. What I do recommend is that you always ask yourself this question, whether you're thinking of investing in Palantir or you're currently invested in Palantir. In the last section of this video, I want to touch on Donald Trump's tariffs and the repercussions this will have on the market. So just for some context, Donald Trump announced 25% tariffs on imports from Canada and Mexico, and on top of that, tariffs from goods coming from China. On that same day, Canada and Mexico found ways to circumvent those imports by meeting with Trump and finding some workarounds to the situation. So the result is that the tariffs that were previously planned on the US's neighbors have been postponed for another month. And I've had people contacting me and asking me, is the stock market gonna crash? Is it time to sell my stocks? And my answer, in very simple terms, is no. Point number one is that nobody knows what effect Trump's tariffs will have on the economy and on businesses and stock prices. At the end of the day, tariffs are a very blunt tool, like interests, and history has shown that when tools like this are used on the economy, the consequences are not always very straightforward. For example, tariffs on China were first implemented by Trump in his first term in 2019 and 2018, and look at what the results of the stock markets have been so far. By the way, those tariffs on China are still in place today. Another more recent example is the interest rates increase from 2021. Everybody thought that it would cause a recession, that stock prices would go down. If you had sold your stocks at that point expecting interest rates to go up from 0 to 5%, you would have been right in thinking that the interest rates would go up to 5%, but you would have been wrong in the direction of the market. The problem is that when you sell your shares, at what point do you get back in? A lot of people who sell their stocks and sell their indices end up waiting for years and years for the stock market crash that never happens. Actually, maybe it does happen 5 years from now, 10 years from now, but the bottom of that crash will be higher than when you sold your stocks 10 years ago. So you're always better off just staying invested in the market no matter what happens. If the stock market goes down, if the stocks that you own go down, then average down, buy more at a lower price. This is what Warren Buffett, the GOAT himself, was saying in an interview back in 2018, back when people were asking him whether it was time to sell stocks due to Trump first implementing tariffs on China.
We did talk at the top of the last hour about what the China tariffs potentially mean for business and what they mean for Berkshire. But you're looking at the markets down almost 500 points this morning. And for people who are just waking up and just kind of trying to figure out what this means for them, for their portfolios, for their businesses today, I'm sure they've got some questions.
Well, I'm saying if you own a farm and you're worried about selling your farm because you read the newspaper this morning, or if you own a perfectly decent business in your town and you're worried about you think you should worry about selling your business today, because then you should worry about thinking about selling stocks. But if you look at stocks as businesses that you own little pieces of, why in the world should you sell it based on headlines of any sort? I mean, if you expect a farm to be a good investment over 10 years, if you expect an apartment house to be a good investment over 10 years, and if you own a marketable security, which is an interest in a business, and you expect that business to be a good business over 10 years, it's nonsense to get feeling good or bad about what stock prices do in a day, unless you have extra money and they go down, and then you feel better because you can buy more of them cheaper. You make business decisions, but you don't make a decision about whether to buy or sell the business if you've got a good business. And you've got to, if you're going to own a business for 10 years, you're going to see a lot of terrible headlines. Mm-hmm. You know, I bought into my first business in 1942, and they didn't notice that I did. But just imagine all those headlines at that time, and the world, the Philippines were falling. I mean, we were losing the war, and but the United States is going. Your kids are going to live better than you did, and your grandchildren are going to live better than they do. And generally speaking, productive assets are going to be worth more in this country. And if you own a diversified group of productive assets, you'll do fine as long as you don't read the papers.
So there you have it. Let businesses make business decisions, but don't decide whether or not to buy or sell the business based on, macroeconomic factors. This is the beautiful thing about businesses, is that they're dynamic, they're living things. They can reinvest money that they generate to create more returns. They can also adapt to the times. What's the perfect vehicle to fight off inflation? It's a business. What's the perfect vehicle to fight off tariffs? It's a business. Why? Because in both cases, businesses can transfer those costs back to the consumer. It's sad to say, but the reality is that whether it's inflation or tariffs, businesses actually protect investors from those things. The people that end up paying the most are consumers. So I agree with Warren Buffett from 2018. I think that any dip in the market that is caused by, tariffs or Donald Trump, I think that these are all short-term headlines, and that within the next few years, we'll have all forgotten about these little dips. You just have to make sure that you're investing in high-quality companies at a fair price, and everything will be okay. That's it for this video. I hope you got something out of it. Leave a like to support the channel and subscribe if you want to see more content like this on stocks and long-term investing. I'll see you in the next one.